Good morning, everyone, and thank you for joining us today for the first of CBM's two year-end tax planning and market update webinars. We do have a second session scheduled on December 5th at 11 o'clock. The material will be the same. However, our two presenters, Richard and Gregory, have a lot to share. So if you think it might be valuable, you're also welcome to join us on December 5th to catch up on the content there as well. We have scheduled this to be a 1-hour session. However, if for whatever reason the session does go long because the content or the Q&A goes a little bit longer than an hour, we'll be sure to acknowledge the hour mark at 9:30 and give you the option of staying on if you'd like to, or to move on if you have other commitments. So you have that option. Our presenters today, as I mentioned, are Richard Morris and Gregory Estes, and I'm going to introduce them in a moment. But I just wanted to take care of some housekeeping items. First of all, this is a year-end tax planning webinar and a market update session. So while you have an hour of Richard and Gregory's time today, we hope you will consider reaching out if you need their assistance or would like to reach out with further questions after this session. We are recording the webinar. And so within the day or two after today, we'll be sending all of the attendees a copy of the slides and a copy of the recording, as well as our presenters' contact information. So again, I would encourage you to reach out if there's information they share that would be helpful that you wanted to follow up with them on. Thank you for those of you who have submitted questions during the registration process. Those have been submitted to our presenters, but you're also welcome to use the chat box throughout the session. I have a feeling our presenters will be concentrating primarily on the content and then get to the Q&A a little bit later on, just so they can get through all of the content they want to share with you. But please, again, like I said, please feel free to use the chat box. We are offering CPE for this session. So what I'm going to do now is launch a sample poll, which you'll see on the screen. Let's see, it'll show up in the chat box or it will show up on the screen. I'll be launching 4 polls over the next hour. This is a sample one. You don't need to respond, but please do respond to 3 of the 4 polls that we'll be launching over the next hour or so if you would like to receive CPE. Let's see, what else do I have here? There will be an evaluation as well towards the end of the session. So when I announce the final poll, I'll also announce that I'm putting a link to an evaluation form in the chat box. I would please encourage you all to fill out the evaluation form. Let us know how you think we did. This does help us for future programming. So let me give now a brief introduction to each of our presenters, and then I'll turn it over to them. Richard Morris is a partner and the director of CBM's tax practice. He has more than 35 years of public accounting experience working with closely held businesses, their owners and executives. He also has extensive experience in estate, trust, corporate, individual, and partnership taxation, and he specializes in working with clients with unusual or complex tax circumstances. Richard speaks on new developments and strategies for corporate and individual taxation, including year-end tax planning, as well as federal and state tax development. He works closely with clients in the local community to navigate the economic changes resulting from tax changes and economic policies resulting from the COVID-19 pandemic, such as the CARES Act. And he was quoted twice by the Washington Business Journal a few years ago on the Paycheck Protection Program loan forgiveness program. Gregory Estes is a senior portfolio and relationship manager at May Barnhart Investments. He has nearly 30 years of building successful client relationships, managing portfolios, developing client investment strategies, performing equity research, and leading compliance-based risk management strategies. He helps oversee the wealth management goals of MBI's high net worth clients by cultivating relationships and providing customized research, analysis, and informed guidance. He's also a chartered financial analyst, one of the industry's highest distinctions in the investment management profession. So with that, I'd like to welcome you once again to our session this morning. I'm going to turn it over now to Gregory. Oh, Greg, you're muted.
Little technical issue to start the webinar. Thank you, Joe. Again, my name is Greg Estes, and I am with MBI, which is the Wealth Management Division of CBM. I'd like to start my market update. We'll just spend a few minutes giving you kind of an assessment of where the market is and what our outlook is, just by offering up a little humor in honor of our recent Thanksgiving holiday. Um, inflation has been at the forefront of most investors' minds, and I think cartoonists are really good at tapping into what people are thinking about and what they're really concerned about. Um, Obviously, food inflation is an issue, and it really impacts everyone. But for the Fed, they don't really pay attention to food inflation, unfortunately. Food and energy are considered too volatile. So when they are looking at inflation, they are looking at something called core inflation, which excludes food and energy when they are making their assessments of inflation and what their response, their monetary policy should be. My second cartoon, if you're unfamiliar with the Federal Reserve Chairman, that's Jay Powell, and he's flying the U.S. economy, and he's trying to land the U.S. economy on the soft landing runway. This is one of the narratives or working theories that a lot of investors have. That is the idea that the Fed is going to be able to, through its interest rate policy, through its quantitative tightening approach, will be able to slow the economy and glide that plane onto a nice soft landing. It's a bit of a Goldilocks scenario, but as we'll see, this narrative of a soft landing definitely seems like it's taking hold in the marketplace as opposed to the hard landing, which would mean more of a deeper recession caused by the Fed's interest rate increases. So if we go to the next slide, we will take a moment to stop talking about monetary policy and talk a little bit about fiscal policy. That is the side of government that is responsible for spending money. So that's really Congress, most specifically the House of Representatives that controls the purse strings, but also the executive branch, which implements a lot of that policy. And as you probably well know, over the past several years, Congress has not been functioning in a normal mode. And there have been studies about government shutdowns, which have become more common. And a lot of this information, academic research on government shutdowns, indicates that more of the volatility occurs before the government shutdown. So average decreases in the market tend to be about 8 to 10% before the shutdown. Why? Because uncertainty is higher. We don't know whether it's going to happen or not before the shutdown occurs. But once we know the shutdown has occurred, well, this infographic does a nice job of showing you what the performance of the S&P 500 has been during these shutdowns. And you can see the longest shutdown actually saw the S&P increase almost 8%. So really the takeaway from this is that the uncertainty before a shutdown is a bigger deal than the actual shutdown. Now, we've already avoided two in the past month and a half. The new Speaker of the House, Johnson, still has to thread the needle, but fortunately, that specter of shutdown has been punted until early into next year. So this will be a topic that will be revisited next year. With that, I want to get back to the economy on the next slide and talk about where the economy is today. And I thought the best way to talk about it is not so much to show you a bunch of different data points out there, but to show you an amalgamation, an economic surprise index, which shows you how data releases as a whole look versus what was expected. If you were a gambling person, you would say, hey, how am I doing against the spread? It's not so much whether my team won or lost, but if I beat the spread, right? Well, this is kind of a measure of how the economy is doing versus the spread versus those expectations. So if economic releases come out and they are above the expectations, then the economic surprise index is above zero. And as you can see where we are today, those releases have been better than expected. Now, why are we talking about the economy doing better than expected? That sounds like a good thing. Well, when the Federal Reserve is in the mode of trying to control inflation, they're actually, through their interest rate policies, trying to slow down the economy. So if the economy is proving resilient, that can be somewhat of a problem. It's a challenge to bring down inflation. We do have some what I call positive developments, and I have that in quotes because they're actually somewhat negative for the economy, but they're positive in the sense that with a slowing economy, we might be headed for the soft landing that investors want. First on that list is a definite positive development. Inflation is slowing. That's good news. We've seen in the most recent release inflation come down. Um, Headline inflation was below expectations. Core inflation, which excludes food and energy, also below expectations. So this is all to the good. There have been softer jobs numbers. The most recent non-farm payroll was up 150,000, which is below kind of a $200,000 or 200,000 mark, which is good. The looser jobs market, that is, the jobless claims are at a 3-month high, which again sounds bad, but is actually good for the idea of a slowing economy. So what this means is that core CPI is coming down. So you have this red line showing you what core CPI is today. It's at 4%. The Fed wants it to get to the green line of 2%. That's why they have the Fed funds rate so high. That's the blue line. Now, there are some complications to this. Wages are sticky. That could mean that if wages remain elevated, that red line may not approach 2% quickly enough. There's also this idea of onshoring or nearshoring after COVID, after the COVID shutdown. A lot of companies realized that their supply chains were maybe too concentrated in China. So they've moved to diversify that supply chain. Some of that manufacturing maybe have been brought to close to the US or in the US, and that's more expensive. Those costs get passed on to consumers. Higher regulatory costs are always passed on, generally speaking, to consumers. There have been higher regulatory costs in the form of environmental requirements that will get passed on to consumers. And last but not least, the complication is consumer spending. There have been some reports that consumer spending is slowing, but we are entering a period of time with the holiday season where that is a highly variable, highly volatile issue, and consumer spending could easily outpace expectations or underperform. So that remains to be seen. So on the next slide, we're showing you where are we as far as interest rates. And I've already shown you the Fed funds rate in the previous slide, but this is giving you more of a long-term perspective. And I've titled this slide New Interest Rate Regime because the old interest rate regime, as you can see, from the end of the Great Recession for the next 7 years was a zero interest rate policy. Inflation was very low and interest rates were very, very low. There was an attempt by the Fed to increase the Fed funds rate, but that ended with COVID. And you know the rest. Inflation began to pick up. The Fed was behind the curve and began to raise the Fed funds rate very aggressively. But so the new interest rate regime is this idea that rates are higher and they're going to stay higher for longer. This is a bit of a different narrative than the soft landing because it's basically saying that, hey, inflation may be very difficult to bring down to 2%, so the Fed's going to have to keep rates elevated. The reality is these two narratives are not necessarily mutually exclusive. We could be seeing a softening economy, which at some point in 2024 does mean that the Fed will cut rates. However, going back to that zero interest rate policy does not seem like something that's in the cards. So there's an element of truth to both narratives in the markets. So I want to switch gears by hopping over to how stocks have done in the next slide, which and we're showing the classic Morningstar style boxes. So if you look at the box, for example, on the left, that's 2022. The columns starting on the left, value, then the middle column of core, then the column on the right is growth. From the top to the bottom, large stocks, mid-sized stocks, and small stocks. And you can see that growth stocks really fared very poorly in 2022. Only large cap value managed to hold on in 2022. And that's really due to the fact that interest rates were going up so much that stocks were punished for that. And growth stocks were more punished for it because they tend to have longer payback periods than value stocks. So they were much more out of favor. Now you look at 2023, and it's a bit of a reversal from that in the sense that large cap growth is leading the way, and it's a really concentrated market. I should point out that this information that we're looking at is through October 31st. So you can see that the gains in the market have really been concentrated in large cap growth, and we still are seeing mid cap and small cap through October 31st out of favor and not really participating in a market rally. But as the next slide will show you, that has changed in recent weeks. So as I mentioned before, inflation numbers looked much better in the November release. So, the headline inflation, core inflation were better than expected, lower than expected. Even producer price index, which is what producers are paying for the inputs that they use before the products are finished, that posted up 2.4%. Well, it was expected to be up 2.7%. That again is a gauge of a forward look at what inflation is going to look like for consumer inflation. So again, a very positive sign. And these were released in around November 14th. So if you look at these tables, the table in the upper left is showing you what the indexes were doing at Halloween, basically. So the Russell 1000, that's a large cap index. That was up. It was really the only thing that was up. It was up about 10.3%. Mid caps and Russell 2000 small caps were still in negative territory. The MSCI All Country World ex-US, so everything outside the US, was barely up. And then the Bloomberg Aggregate Bond Index, that the fixed income market, was negative. Well, with the positive information on inflation, you can see the table on the right, how things changed. The Russell 1000 continued to rally, but we're also now seeing that mid caps, small caps, international, the market is starting to broaden. And another point I want to make here is that the market tends to move not smoothly, but in fits and starts. So there could be, a market where you might be invested in something and it's not performing well, and then within a couple of weeks, the story is a lot different. And that's certainly been the case here. Through the end of yesterday, the indexes are roughly the same as they had been after through 11/15. So there hasn't been a whole lot of change there. But like I said, the markets move quickly with new information. The chart on the bottom is interesting. This is a yield curve. So when you look at this, what you're looking at are yields for treasuries. And we start at the left. Those are the shortest term maturities. So at 1 month, and you work your way out to longer maturities as you look to the right of this chart, all the way out to 30 years. So the blue line is corresponding to the end of October, and it's showing you rates are higher on the short end of the curve, and then they decline the longer the maturity. This is really a signal that the market thinks that the economy will slow and that the Fed will cut rates. After the inflation news, the short end of the curve stayed relatively the same, but the longer end dropped even further. This is the market telling you that they believe that the Fed is going to be cutting rates sooner because the information that they're seeing seems to play into this idea that we are headed for a soft landing. Now, I've highlighted here the 10-year Treasury yield. It's moved from 4.88% at the end of October to 4.53%. That may not seem like a lot, but that's actually a huge move for a 10-year Treasury. And that is really constructive for stocks because stocks rely on the idea of interest rates. And the higher interest rates are, the more difficult it is for stocks to appreciate. So continuing with the idea of stocks, I'm going to head to the next slide.
Hey, Greg, let me just quickly interject here.
Sure.
Excuse me. I'm going to launch the first poll. You don't have to pause in presenting, but for those of you interested in CPE, please respond to the poll on your screen or in the chat box, and I'll take it down in about 30 seconds. Thank you.
Okay, thanks, Joe. So there is value and value stocks. What I'm doing in this chart is comparing a big basket of growth stocks versus a big basket of value stocks, and what the relationship is and how expensive these two are. And as you can see over time, growth stocks are always more expensive than value stocks. That's kind of a given because investors prefer earnings growth over more stable businesses that have lower earnings growth. But how expensive they are does change over time. So you can see growth stocks were very expensive relative to value stocks in the late 90s during the dot-com bubble. And they've been expensive relative to value stocks in more recent history. So if you were looking at where to place money based on what's cheaper, well, value stocks are cheaper than they've been and for quite some time versus growth stocks. That it does tell you not only that they're cheaper, but that growth stocks have performed very well in recent history versus value stocks. So there's something to consider in your portfolios. Shifting gears to fixed income on the next slide. This table may look confusing, but it's actually just segmenting the fixed income market across different categories. So I'm going to start with the bottom row. And what we're showing you is year-to-date performance in these different categories for fixed income. So all of them start at zero because we're starting the year, we haven't made any money. Treasury bonds, these are the longest maturities out there. Well, interest rates were lower at the beginning of the year than they are today. They've moved up. So longer term maturities are more sensitive to interest rates. So when interest rates go up, longer term maturity bonds go down in price. And you can see that the year-to-date performance in treasury bonds has been quite negative compared to other parts of the fixed income market. I do want to point out, if you move up a few rows, treasury bills. These are the shortest end of the treasury market, and those have had a steady increase over time. It makes sense that they would have a steady increase because you're simply rolling treasury bills over and earning a positive return. And those have been a good place to be. So if you were looking at your fixed income portfolio, you would probably want to be what we would call shorter in maturity. Although you might want to consider at some point, if interest rates do decline, extending your maturity a bit to capture the benefit of falling interest rates. Continuing with the idea of short maturities, cash on the next slide is obviously the shortest of maturities, really rolling over every day. And I like this infographic because it's showing you the odds of cash outperforming stocks in any one period of time. So that left bar is showing you what are the odds that cash can outperform stocks in one given year, and the odds are 31%. So in other words, about 69% of the time stocks are going to do better than cash, but you have your highest odds of beating stocks in any one year holding cash in that period of time. Now, the longer the period of time, the less likely you are to outperform stocks by holding cash. And really, the takeaway from this should be, I know people get concerned when markets go down like they did in 2022, but you don't want to lock yourself into holding cash for a long period of time because it's not a very constructive place to be. Now, there is a benefit in today's market because interest rates are higher than they had been for a very long time. But just consider that holding cash for an extended period of time may not be the best decision to make. I'm going to flip to my next slide, which is showing you a class returns quilt. So I know this looks kind of confusing, but it's actually pretty simple to follow. Every year is a column here. So we start at 2012, working our way through 2022, and then through year to date 2023. Each of these boxes represents a different asset class in the market. And so one of the things that you'll note is that the order of these boxes changes. The top of the column is the thing that performed the best in that year. So in 2012, for example, international emerging markets performed the best. What should you take away from this slide? Well, that leadership in different asset classes changes over time. So you do not want to put all of your eggs in one basket because leadership in asset classes changes over time. So we want to maintain diversification, not only within within a stock portfolio. You don't want to have just a handful of stocks. You want to have more diversified holdings in stocks or ETFs, but you also want to make sure that you're not overly focused, for example, in large cap or large cap growth, that you have small cap and mid cap. Even if you look at it and say, well, it's not performing well this year, just wait. When you're investing in stocks, you're investing for a long period of time. So these leadership categories do change over time. I'm going to wrap it up with my final slide, which is some takeaways and top ideas. And the top one is tax loss harvesting. So the idea of we're heading towards the end of the year. If you have capital gains and you have positions that are in a capital loss, you should go ahead and sell them so that you can realize some capital losses to offset capital gains. Now, last year, 2022, was probably a bigger year for realizing tax losses, but you still might be able to find some positions in your portfolio where you can realize some taxable losses. I've mentioned here small caps and high dividend equity. Your mileage is going to vary really on when you purchase securities in your portfolio. If you do realize any capital losses, just make sure that you do not repurchase that position. If you like the position and you want to get back into it later, you've got to make sure you don't repurchase it within 30 days, or else that tax loss will not count for you. Consider adding duration to your bonds. I mentioned this before. So what's worked so far this year has been short duration or short maturity bonds, but with the idea that the Fed is not likely to increase rates going forward, but rather that rates would go down, you can benefit by adding a little bit of duration or maturity to your portfolio and fixed income. I already mentioned that value is cheaper than it's been in quite some time versus growth. Well, small cap value is probably the most overlooked among the value categories. So you might want to consider looking into small cap value. And last but not least, I do want to mention, make sure that you're taking your required minimum distributions if you are of the age where you have to take RMDs from your IRAs. As well, qualified charitable distributions. If you're going to do that, that's a great way to reduce your tax burden from IRAs if you have to take required minimum distributions. And with that, I'm going to turn it over to Richard, who's going to talk about tax planning.
All right, you know what? Let me interject again, since this is a good time to launch the second poll. So this will be up on the screen in the chat box for about 30 seconds. Richard, you can start presenting immediately. Just wanted to let everyone know it's there for them to take if they want to poll.
Thank you, Greg. It just shows how tumultuous the markets have been these last number of years with everything going on, be it coronavirus, be it the policy beforehand, and then everything trying to address that. So as we wrap up 23, it's a good time to take a closer look at both tax and financial planning. Year probably brought a lot of changes, some disruptions, some inflation, some political shifts. So we're going to talk about, there is still legislation sort of follows a pattern going back to President Reagan, in that a new president has sort of a signature piece of tax legislation early on, generally in the first year. If they end up having a second term, there's usually a second piece, sometimes more sweeping. In President Reagan's case, it was the '86 Tax Act, which redid everything going back to the '50s. In President Clinton's case, there are a lot of changes to capital gains and your home sales and things like that. So it does happen. So short answer to say there wasn't a lot of legislation last year, but there were a couple key pieces that went through. And then what we have looming over all this is the sunsetting, with the expiration, in layman's terms, of the 2017, what was called the Tax Cut and Jobs Act. So a lot of those changes are set to expire at the end of 25, which seemed like a long way away. And now we're realizing it's pretty short. So one of the pieces that came out is what's called the Corporate Transparency Act, and that's effective January 1 of next year. And really what it is, it's a money laundering regimen. So the idea is to disclose who the actual owners are of certain corporations and LLCs. So, if you have the 123 LLC, you don't know who owns it, as opposed to like the Richard Morris LLC, for example. So there's reporting that has to go on. You have a year to do it if you're in existence by January 1. The changes is in 24, you have 30 days of any change in ownership to make these disclosures, $500 a day. So that is real money. And I'm sure you've read about it. And then some of the states, New York in particular, are piggybacking on that. So that's something to be aware of. The next piece was the Secure Act of 2022. Why are we talking about 23? Because none of it really was effective until 23. But that sort of changed foundationally a lot of the preconceptions about retirement that we grew up with, about longevity and about your assets lasting that long. So with change in the required minimum distributions, changes in the penalties, for people who haven't been as fortunate or planning, you get to put in more money to catch up. And we'll talk about Roths, which are a non-tax deductible but tax-free when you pull the money out, and then 529 plans, which are education and don't really seem to fit in with all that. So I talked about the Secure Act 2.0. Well, what if we missed the Secure Act 1.0? So the Secure Act was, was right pre-COVID, and so it got delayed with COVID, sort of forgotten about during COVID. And it changed one of the odder rules in tax law, which was when you got to age 70 and a half. Now, as George Carlin said years ago, you talk in half birthdays till you're about 5 and a half. And then you start again when you go, oh, I'm 89 and a half. But usually in that general middle, you never talk about half ages. But this law said when you got to age 70 and a half, you had to start making what were called required minimum distributions. And why do they exist? Because when you put money in your retirement plan, a 401k, an IRA, the class ones, you generally get a reduction. You get a reduction in your taxable income. If I put $100 in, my taxable income goes down $100. So the government hasn't gotten taxation on this for all during your working lifetime. So they said, you know what? There's going to come an age, and we decided at 70 and a half, you had to start taking these distributions. And then there are other rules. If a spouse inherited an IRA, they treat it as if their own and went forward. If a non-spouse inherited, one of your children, then they got to pay it out over their life expectancy. Okay, because these required distributions were paid over your life expectancy that the IRS determined. And basically, they determined that at age 70, it was around 28 years. So, but these, when they were passed to non-spouses, they get paid out way longer. So, example, 90-year-old parent leaves it to a 64-year-old daughter. That daughter has a 25-year life expectancy. So that's getting stretched out. That was the term stretch. So it's taking the IRS longer and longer to get their money. So what they said in 1.0 was, all right, you're going to have 10 years. Non-spouses have 10 years. And of course, there are some exceptions in there if, minor children, chronically or disabled beneficiaries. If you're really close enough in age to the decedent anyway, Your life expectancy is that much different. So that was the 1.0 act, and that sort of got caught up in COVID and everything and delayed in those things. So then came Secure Act 2.0 and said, you know what? Turns out people are living longer. And so we probably should reflect that. I mean, going back, Social Security was originally set at 65 back during the Depression. Why? Because life expectancy was 65. So it's like, all right, we'll start paying you at that point. But those have never really gotten changed. So now what this does is it pushes it a later and later start date, depending upon when you were born. So basically, if you were born in 1960 or later, it's 75. If you were born before January 1, 1960, consult your advisor on to do that. Now, this really only applies to about 20% of the people anyway, because most people are taking more than the minimum anyway. But also, there were some pretty heavy penalties. So under the previous rules, if you didn't pull it out, if you did not meet the required minimum, not only did you take it into income in the year it was discovered, but you had a 50% penalty. So if I didn't take out $10,000, I had a $5,000 penalty. So they've changed that to say, all right, well, if you haven't done it, it's going to be taxed at a 25% rate, regardless of what your bracket is. But if if you catch it and correct it, we'll only tax it at a 10% rate. So there are some savings there. And then what I called the stretch on the last slide. Basically, you got to pay, if you're non-spouse, you have to have it paid out within 10 years. And we'll get to how you figure that part out. But also, not everyone got to age 50 and was in a good place to retire, whether they're retiring in 10, 15, 20 years. So there has been this provision where we call catch-up contributions. And the current catch-up, for IRA has been, $1,000 for age 50 or older. So you could get through a little bit more money in there. For 401ks, it was a higher amount for you to retire those retirement plans. So now what we've said is, all right, here's what we're going to do. We're going to let you put in even more. So if you're in this 4-year window, and again, some of it's how they get it through the budget. If you're between 60 and 63, the catch-up gets to jump, the regular catch-up starting at age 50, from 7,500 to 10,000. So for those 4 years, you can put in another 2,500 per year. You can see where it's getting a little bit complicated. However, if you make too much money, which is 145,000 in this case, it has to go into a Roth. Now let's review what a Roth is. A Roth is when you put money into a regular retirement account, 401k, 403b, IRA, you get a tax deduction, as I talked about. A Roth, you don't get the deduction. Okay, you don't get the deduction, so it doesn't help you in the current year taxes. The difference is with a Roth, when you pull that money out, there's no tax on it. Regular retirement account, you pull it out, it's taxed. So what they're saying is, all right, we'll let you do this, but if you make, 145,000 or more, it has to go into a Roth. Not it can, it has to go into a Roth. So that's sort of good news. Bad news is, bad news, I'm paying tax on it this year, but the good news is it's going to grow tax-free on the backside. So, sort of giveth and taketh away. But the key part is you get to put in more in a certain age group. And it means your employers might have to make some changes to their plans, but most are pretty current on that. 529s, how does education get in here? The 529 plans are sort of the savings account, not sort of, they are the savings account for college. Although you can use them for, now there's certain cases you can use them for, primary and secondary education. But there are some where people have overfunded them. So beginning this year, you can roll over non-tax college money into non-tax retirement money. So, up to 35,000. It's sort of a narrow needle to thread. So you have to have too much money in there, and in your retirement accounts, in your college accounts. But if it does, you can put up to 35,000 into a Roth IRA, which then, of course, grows tax-free for much longer. But again, in terms of the threading the needle, you can do 6,500 a year to get to the 35,000, but it can't be a new account. So you can't open a new account. This is a great idea. I'm going to put 35,000 into a 529 plan. Has to have been open at least 15 years, but it does improve the versatility of it. I mean, these plans have been around long enough that it is a valuable tool there. Roth changes. So again, in terms of, part of the whole idea, the government's idea is to get you to put money away for yourself so that you're not relying on Social Security. So it's to expand all these opportunities. A simplified employee pension plan, what we call a SEP or a simple, basically their retirement accounts for self-employed is one way to think of it. And so now they're allowed to have Roth accounts, okay? But you have to include it in the overall calculation of, because there are limitations again on the income side, whether you can put a contribution into a Roth or an IRA as well. And then now if your employer contributes to a retirement plan, it is not considered income to you. But if your employer does it to your Roth SEP or Roth Simple, then it's not excluded from gross income. So there are some minor changes there. And then that begins starting in 23. So that applied starting this year. QCDs, again, this is another part of retirement plan. What is a QCD? Greg talked about a QCD. Qualified charitable distribution. So what does that mean? We talked about our required minimum distributions. You're required to take a certain amount of money out every year, and that's considered taxable income. So if I have to take 150,000 out of my retirement plan because I've been a successful retirement saver, I'm going to pay tax on that 150,000. But if I want to give it to charity, I would have the income of 150,000. I'm charitable. I give 20 away. We know there are changes to the standard deductions. I might not get a deduction for it. So there's a provision now where you can give it to a qualified charity, which means your 501c3s, that you can give the money from your retirement account right to the charity. You don't pick it up in income. So my 150 now went down to only 130, and I don't get the deduction either. Why would I want that? Because a lot of the tax limitations and rates all kick in based on a measure of your gross income. So if you're not increasing your gross income, it may be more valuable than losing the deduction. So it's something to think about and have that discussion when it comes to tax time. And this still applies 70 and a half and older, but that moves up as you're required to take the RMDs. So the RMDs can go right to a charity up to these limits. Will be indexed for inflation starting next year. And then there's a once in a lifetime you can do up to 50,000 to special charitable trust. They're called CRATs and CRUTs, and basically you give money to a charity and then they give you some income during your lifetime. Your alma maters are really good at pushing those, and this is the time of year you get those mailers. Let's talk about some things that were extended. Alternative fuels. I mean, we've heard about electric cars, and we're going to talk about all that. Those were extended to 2024. The credits for alternatives, but also this one concept that came out was the excess business losses. And the short answer is you used to be able to deduct your whole business loss, a net operating loss, against your other income. But that changed. And so now you're limited on how much you can take, and that excess gets carried forward into the next years. So now for 23, the limitations are approximately 290 and 580. So let's say you're a married couple and you have a $600,000 loss. That excess amount then is going to carry forward. You'll get up to 578 against your other income, your investment income and retirement, whatever it is. So that's one that can catch people because, again, it was sort of a generational change. The losses, you were able to carry them forward, carry them back, and now you're limited on how much you can take in the current year. So if you're in one of those situations, you need to make sure you're taking a look at what those would be. In terms of what retired, employee retention credit. I mean, these were basically money the government would give you for keeping your employees during COVID. And so there was a plan, and basically there was pretty complex reporting. And you know it got out of hand when you heard all these commercials from people saying, yeah, the government's going to give you money. And it got so out of hand that the government came out and said, you know what? We're going to let you withdraw these claims without penalty, and we'll pretend it never happened, because you had these aggressive, fraudulent preparers for these things. Anytime you're hearing an ad on the radio for these things, you know it's gone too far, whether it's William Devane for gold or Camp Lejeune. So the IRS said, you know what? No harm, no foul. You can withdraw them before they're processed. We're not going to look into the fraud and everything, and we'll act like it never happened. So there is a specific procedure and provision for that, to avail yourself of that if, for whatever reason, you realize that not something you want to do. One of the other unintended consequences of the Inflation Reduction Act was, everybody's using Venmo and all these pay apps. And government said, oh man, clearly people are making money. We need to crack down on this. So the rule was, if you got more than $600, you were going to get a new form from the government called a new type of 1099, like you get for interest and dividends and those. So if your PayPal or Venmo is $600, you have to prove to us it's not income. Well, so that means if you went out and you split a meal with somebody, if you're buying tickets and Venmoing somebody, and it turned out there would have been 44 million of these forms filed. So, there was pressure they put back, and they said, you know what, here's what we're going to do. We're now going to make the reporting floor $20,000 worth of activity and 200 transactions, because all those transactions would be an indicator that you're in business, as opposed to, splitting dinner checks and buying tickets and those things. For 23, for 24, it's supposed to drop to 5,000. And we'll see what happens with that. But that was one that really nobody was happy with that one coming.
Richard, I'm going to go ahead and launch the third CPE poll now, but you can continue your presentation.
What else is expiring? This is a big one for business. So one of the things that came out of the pandemic was essentially you could write off a lot of business property in the year you bought it, and it was called bonus depreciation. And hey, it was great. It did what it was supposed to do. It kept people, in business and working. So now that 100% is slowly decreasing the amount that you can take. So as you can see on there, for 23, it's going to be 80%. For 24, it's down to 60%. So it is stair-stepping away. Another thing that totally went away was during the pandemic. Again, you could delay paying half your Social Security taxes, the employer half of it. And those were due December 31 of last year. And then we talked about the Tax Cut and Jobs Act is supposed to sunset in end of December 31, 2025. And that's far reaching. I mean, that's the SALT tax, that's the estate tax, that's the tax rates that we have now. So that is far reaching. So, and of course, that's going to depend on what happens in the election next year. But that's something that you're going to be hearing more and more about. But there's some planning that might need to take place prior to that to take advantage of those opportunities. I'm going to touch on some just inflation adjustments. So what we've got on the screen is just the changes that some of them we talked about already, and how much you can put into certain types of retirement plans. The adjustments this year are less than they were last year because there was less inflation in 23 than there was in 22. So last year, a number of these took some pretty big jumps, $1,000 more, and this year it's pretty minor, relatively. Clean vehicle credits. Not going to go all through this. Really, the slide is really complicated and messy intentionally because the rules are complicated and messy. The idea basically was we need people to build electric cars in the United States or North America. And so there are these credits, and you'll hear 7,500, but it only applies to certain ones, and it's whether they're mined and assembled in North America and all these pieces to it. if you're going to buy one, make sure you go to the government's website and make sure the vehicle that you're buying is listed on there, qualifies for it, because there's, obviously we all know they're substantially more expensive than conventional internal combustion engine cars. So just make sure it's an eyes wide open, because there are so many limits in there. And also, person A might qualify for the $7,500 credit, but person B, if their income is over one of these limits, would not qualify. So you might think, hey, my whatever, I'm going to get this credit. It's going to reduce the price. It may not. But then there's also the prices of the vehicles themselves. So it is something where you need to do your homework for that. Look at your own situation. Nobody can tell you that more than you can, but also look and see what whether the vehicle qualifies. Right? And it doesn't matter anymore whether it's a domestic or foreign nameplate. It's where it's built and assembled. So we're getting closer to the end of the year. Greg talked about taking, tax losses, all these things as we get to the end of the year. It is time to take a look and see, look at your withholdings if you haven't looked at them, whether they're from earned income, retirement income. You have until, it's not as crucial anymore to make them before the end of the year because of the state tax limitations. So you have till January 15th in terms of making payments, but for withholdings and those things, the idea is to avoid unwanted surprise next April. Okay. And also to avoid penalties, because if you haven't met certain limits, there are penalties that apply on top of that. So generally, we're trying to avoid those surprises. This is to show really, there are minor increases in the brackets. They're always adjusted for inflation. This goes back about 40 years now. But these brackets could go away because these are all post 2017 brackets. So you would lose that bottom bracket, and that top bracket would go to 39. So substantial changes in there if things just go away. Nobody knows what's going to happen at that point. It's a different Congress and everything, but it's something to be aware of. But so these are the 23 brackets. Dividend capital gains rates. When they talk about the capital gains rate, that's the maximum. It's not a flat tax. It's the maximum that they're taxed at. So really, there are provisions where if your income is below a certain amount, you really pay a 0% capital gains rate. So again, if for a single filer, taxable income is below 44,625, 89,000, it's possible to pay 0% capital gains on those. Okay, so that's a weird thing. People look at it and go, wait a minute, I have no tax due, but I have taxable income. How's that happen? It's all capital gains. So that's where working with somebody like Greg comes in, that you would say, he says, why do you want to sell the stock? You say, well, actually, if I can reset, pay no tax on the gain. And then, of course, if you're above, then it's actually taxed at a 20% rate, depending upon your income levels. Standard deductions adjusted for inflation. Really, what the key thing here is, you have to look at your state too. Okay, most states follow federal. In other words, if I itemize on the federal, I itemize on the state. If I take the standard deduction on the federal, I take the standard deduction on the state. So a lot of people look at this and say, all right, married couple, 27,700 standard deduction. Sweet, I'm in. My itemized deductions really only totaled $20,000. Well, the problem is, let's say you're a Maryland resident. If you're a Maryland resident, the standard deduction for a couple, is about $8,000. Oh, sorry, no, it's $4,800. So you're thinking, I saved all this money federal, I'm going to pay it on the state. So we need to do an analysis there. Virginia's better. Virginia, for a married couple, it's $17,000, so it's in $10,000 of it. But you need to weigh, the increase in state taxes you would pay versus the federal. So it's not necessarily quick and dirty. We'll always take the higher, and it depends on your individual circumstances. The SALT tax limit is still in effect, which is you can only deduct up to $10,000 of your state and local income taxes. Maryland and New Jersey actually are the worst by this because their state and local taxes. I think 43% of Marylanders and New Jersey people itemize, so lose the most on this. On the deduction side, when it is partially offset by the income side, income tax rates are lower federally, which is the trade-off for the SALT tax. And then if you're in a partnership, there are these pass-through taxes where basically there was a workaround for that. But this is one of those things that could change with the sunsetting. But also remote work and all those issues, states have gotten way more aggressive on that, way more aggressive on that. So the idea that I'm working at my beach house, but I'm really working for, a New York or a DC employer. So it goes more than just, here I was out of the state those days. So be careful. The New England states are very aggressive. Maryland has historically been moderately aggressive, but be prepared to be challenged on that. Charitable contributions, short version is we're back to the old 50% rules. You might want to consider bunching them into like alternative years if you're trying to get over the standard deduction amount. But of course, it's got to be a recognized charity. Again, the government has a website for all those. And if you're giving stuff away, it's got to be in good shape. And then look at the Salvation Army or one of those things, so you're not overvaluing clothes. Crypto, we don't need to talk Sam Bankman-Fried, by all those dudes that have gotten busted. It's still a reportable asset. Okay, the government last year started asking specifically if you were involved in digital transactions. Okay, those gains and losses are very reportable. It is a point of emphasis with them. It is a point of focus. Again, there's a question on the return again this year, like there was last year on that. So of course, obviously, well, A, it's good to tell the truth. B, you don't want to say no and then have records of all these come out, of course.
Richard, I'm going to go ahead and launch the last CPE poll.
Okay.
And for attendees, I'm also going to be dropping a link to a short evaluation form in the chat box. If you don't mind taking a moment of your time to let us know about your experience today, we would appreciate it. Thank you.
Okay. And I'll wrap up to give time for some questions. Estate and gift, these exemptions, the reason I bring them up is because they do sunset. So you might want to look at your gifting in the next 24 months. These are the lifetime limits. It's the same whether they're gift or estate tax. It's just a matter of whether you're, frankly, alive or deceased when you make the payments. So, just below 13 million for 23, 13.6 for 24. And then the annual exclusion that people are very familiar with is rising to 18,000 for next year. It's not just about minimizing the taxes, although it's a big piece of it, but it's updating your documents, making sure you've got the right people involved. Privacy, protection of the assets, during your life and during your beneficiaries' lives as well. And for the state's dramatically different. Maryland, it's $5 million versus the 13, but it's portable. I mean, it goes from one spouse to the other. DC, 4.5 million, not portable. Virginia, none at all. So that's pretty self-explanatory for that. Education, there's nothing new there. It's just sort of a reminder that there are credits out there for college, first 2 years of college, for college and grad school. 529 plans, very popular for a reason. It's a great way for we like to look at it, family and friends and grandparents to put away money for somebody's education. This is just a graphic of when things are due, which is sort of partnerships are due in March. Sort of everything else is due in April at that point. Inflation adjustment, your mileage rate changed a little bit. Moving doesn't change. Medical doesn't change. And then, in terms of planning, with complexity comes opportunity. With complexity comes opportunity. And sometimes it's how you're structured and set up. But we look at all of that. I mean, we talk about estate planning is not just saving money with the federal government, state government, but it's also making sure your wishes, we don't go to work for the government. We go to work for a family. We go to work for our friends, for our faith in our community. And so where we fit in is to help you realize those, get things to where you want them to be when you want them to go. And that's why we like to work, as I like to say, holistically, which is, the family, the business and the individuals, to make sure that we're getting the right results for everybody. So with that, do we have time for questions, Joe? I know we're bumping right up against it, but.
Yeah, no, I mean, I think it's good to acknowledge that we're at the hour mark. So for those of you who need to go, thank you for joining us. But for those of you who can stay on for a little bit longer, Richard and Gregory will be happy to stick around and answer any questions you have. Thanks again for joining us.
So we had some questions that were sent in ahead of time, right?
We did, Richard. Do you want to I'll just throw out a few of these questions. What are the ways for a small business to save taxes? Is one.
That's always the old, what are the smart people doing? I mean, some of it goes back to structure. Some of it literally goes back to how you're formed. I mean, are you a partnership? You're a corporation? Are you sole proprietor? So there's no one silver bullet. Some of it goes back to like the business law stuff you learn first semesters, how you're structured, where you're structured. And then it would have to be in the specifics of what you're doing. I mean, are we probably a service business? If we're producing something, that's where the bonus depreciation, for example, those things. So it really depends on what you're doing to be able to give a more definitive answer on that.
Here's another question. What do I need to do before the end of the year to minimize my taxes? Richard can jump in, but I would just add, as I mentioned before, if you've got capital losses, you might want to consider harvesting them before the end of the year, especially if you have any other gains, capital gains that you would need to offset for the year.
Absolutely. I mean, that's the one. That's the one that is always tough for us, is that somebody they'll take the loss in February. Like, oh, man, we should have taken this last fall. So I mean, that's a very real one, especially things are up and down as they have been. And as Greg said, you can buy it back. But look at what you have. Look at look at your withholdings. Look at last year. See what happened last year and say, well, do I know of anything that's different from this year? A lot of people, this year looks a lot like last year until it doesn't. So until we, buy a house, sell a house, have a chance, have a child, get involved in a new business, inherit some money. Yes, the inheritance isn't taxable, but what those inherited assets earn, because they're invested with something like Greg, are going to be taxable. So it's review is the answer to that. Is take a look and if nothing else, compare to what happened last year, and then that would give you sort of a game plan. If nothing's different from last year, then this year is going to look a lot like last year, because as we saw, all the tables and everything are indexed for inflation anyway. So that'd be my answer there.
One question we have previously submitted, someone who is newly divorced and wants to know what they should be focusing on in tax planning.
I want to write down a question that was in the chat for a second.
Sure.
Actually, I'll answer the chat one real quick. The harvested losses, yes, if they exceed your gains, if they exceed your gains by more than 3,000, that excess does get carried forward. So that's a great question. That's a great question. So let's say you have $10,000 of losses and you only have $2,000 of gains, then you get to take 3 of the losses against everything else. So you would still have 5,000 of losses that would carry forward. The first year for someone who's divorced, and presuming they're not a head of household, it's dramatically different. I mean, the rules are changed now, where for alimony, for example, no longer income or a deduction for somebody. is to probably get with somebody and do really a projection to see, what your earned income could be, what your investment income could be, is there retirement income, but then also deduction wise, do we have mortgage? Do we have real estate taxes? Do we have charity? So it's a lot of things. So it is a time to get with somebody to do sort of a full-blown projection of what your estimate of what your year is going to look like, because everything's in play at that point.
Right. Someone is interested in understanding the calculation for income base for taxing Social Security.
Oh man, that's like a 2-hour presentation right there. There's not a short answer for that. Sorry. I mean, it's there's a pretty good website for that to plug it, because I presume you're still working while drawing Social Security, and then there's that amount you can earn, and once you get above that amount, it has a pretty dramatic effect on your Social Security. So those amounts did get revised probably in 2017, because it used to be, it was like $10,000, and it sort of queered the whole thing. But yeah, that's an analysis that you have, a calculation that you got to do that factors in where you are in your Social Security and what your age is as well.
We have a couple of others that were entered in the chat. And the one was asking if the 2024 catch-up contribution regulation from Secure 2.0, did that get delayed?
Did not get delayed.
Okay.
Did not get delayed. So then, yeah, those January 1. I mean, that's the new catch-up. And those are great provisions. Go ahead.
Are the capital gains income brackets based on total earned and unearned income, AGI, or AGI minus the standard deduction?
Actually, it's on your taxable income. It's on your taxable income. So that's everything. So that's everything. That's income less deductions, whether standard or itemized. That's a great question. Yeah, because again, people get it and they'll say zero tax. Like, how's this possible? I made $80,000 and I have zero tax on it. So yes, because that 80 was in essence long-term capital gains. So it is a great provision. It is a great stealth provision, and that's one that it is worth sort of, looking at your investment and then look at your income situation to see. All right, usually people don't like to defer income, but if I have a situation where I can defer income into a subsequent year, but take my gains this year, I sort of getting my cake and eating it too, because I'm getting my gain and I'm still getting the income, but I'm just getting the income in a subsequent year. So that is a great, that is one of those great planning opportunities buried in the Internal Revenue Code.
Well, that looks like everything in the chat, and so I think that we've covered everything.
Nobody asked you for the top stock to buy in 24. This is a good crowd.
No, they didn't.
Well, thank you, everybody. Appreciate you being here this morning. As Joe said, we're doing it again next week. If you think there's something you didn't catch, or want to pass it on to family and friends, they can drop in as well.
Thank you very much.
I thank everybody.
We got one quick one right at the end here.
Huh?
Carry forward harvested losses? ? So I mean, yes, you can carry some you can take it with you, sort of.
Right. So if it's more than, if it's losses more greater than 3,000 more than your gains, then it carries forward. So if I have no capital gains and 10,000 of losses, I get 3 this year and the 7 carry forward into next year. to apply against losses, and then if I've got no to apply against gains, and if I have no gains, then 1,000 would carry into the third subsequent year. Does that make sense? I'm not seeing the chat for some reason.
Yes, yes, it does make sense.
All right.
We're getting more questions now. How do we report S corporation ownership?
Oh, now you have until January 1, 2025 if you're already in existence. Through the FinCEN, which is the Financial Crimes Enforcement Network. So just like you want to reports on foreign bank accounts. It's the same organization that you report it to, because in its base, it's about money laundering. So it's about finding who is the beneficial owners of these accounts. So those are filings that we'll be doing, helping with starting next year. Because if you're already in existence, you have 365 days from January 1 to report. So, and then you don't have to report again unless your ownership changes. So you're one and done until such time as you change your ownership structure.
Well, I think that is it. Yeah, that looks like it.
All right. Thank you, everybody. Appreciate the time.
Thank you, guys. We'll see you.
Have a great day.